Have you ever looked at a company's financial report and just thought, these numbers seem a little too perfect? Well, you might be onto something. Because without a really crucial behind-the-scenes process, those neat and tidy reports can be, well, just plain wrong. Today, we're going to pull back the curtain on that exact process. It's called making adjusting entries, and it's what separates a misleading snapshot from the true financial story.
All right, let's dive right into the puzzle. What you're looking at here is a trial balance. Think of it as a first draft of a financial report for a company called Krause Consulting. And hey, if you look at the bottom line, it seems great. The debits and credits match perfectly at $34,700. But here's the thing. That perfect balance? It's hiding the real story of what actually happened this month.
So you're probably asking, how can something that balances so perfectly be wrong? That's exactly what we're going to break down right now.
Think of it like this. This report only shows you transactions that happened on specific days, right? But what about everything that happens between those days? What about the office supplies that get used up little by little every single day? Or the work you finish for a client on the very last day of the month, but you haven't sent the bill out yet? None of that is in this picture, and that's the problem.
Okay, so to get from this misleading snapshot to the real story, accountants have these two core principles they live by. You can think of them as the fundamental rules for telling the truth with numbers.
The first rule is all about timing your income. It's called the revenue recognition principle, and it's actually pretty simple. You can only count money as revenue when you've actually earned it. It doesn't matter if a client paid you a month ago. That money only gets recorded as revenue once you've delivered the service. It's about the work, not just the cash.
And the second rule, the matching principle, it pairs perfectly with the first one. It says that any costs you have, we're talking salaries, supplies, you name it, they have to be recorded in the same period as the revenue they helped you earn. This way, you're always comparing apples to apples when you're trying to figure out your actual profit. Makes sense, right?
You know, this old saying is probably the absolute best way to remember these rules. Don't count your chickens before they hatch. That's your revenue recognition principle. Don't record that income until you've earned it. And don't forget the cost of the feed. That's the matching principle. You got to record your expenses in the same period. If you can just remember this one phrase, you've pretty much got the core idea down.
So, how do we actually apply these rules? Well, we use a specific set of tools called adjustments. Let's open up our first toolkit, which is going to handle all the situations where cash has already changed hands, but the actual business activity, the work or the expense, happens later. These adjustments are called deferrals, and the name makes perfect sense, right? We're deferring or pushing off the official recording of the revenue or expense to a later time, even though the cash has already moved. Let's see how this works with our Krause Consulting puzzle. First up, supplies. So the initial report shows supplies as an asset, something the company owns, worth $1,600. But that was at the start of the month. Did they still have all of it at the end? Of course not. They used some to actually do their work. So here's how we adjust for that. It's pretty straightforward. We start with that $1,600 asset. Then we figure out they used $900 worth of supplies during May. So that $900 is no longer an asset they own. It's become an expense for the month. Our adjustment simply moves that value from the asset column over to the expense column to show what really happened. Here's another classic deferral. Krause got paid $2,000 for work they hadn't done yet. In the world of accounting, that's not revenue. It's actually a liability called unearned revenue because they literally owe that work to the client. By the end of May, they'd finished $400 worth of that job. So we adjust the books to move that $400 from a liability they owe over to revenue they've actually earned. Our last deferral example is something called depreciation. That $11,400 of office equipment is an asset, sure, but it's not going to last forever. It slowly loses value over time, and that loss of value is a very real business expense. For Krause, that expense is $190 for the month of May. We have to record that to match the cost of using the equipment against the revenue it helped the company earn. Okay, pause for a second, because this slide is the key to it all. For everything we just talked about, supplies, unearned revenue, depreciation, notice the pattern? The cash moved first. That's a deferral. Now, let's flip it around and look at the exact opposite scenario, when the activity happens first.
This brings us to our second toolkit, accruals. This toolkit is for all the business that's already happened, but where no cash has actually changed hands yet.
And these are called accruals. The idea here is that we are accruing or building up a record of revenues we've earned and expenses we've run up even if they haven't been paid for yet. This is our Activity First toolkit.
Here's a perfect example. Kraus did $1,700 worth of work for a client right at the end of May, but just didn't have time to send the invoice. According to our revenue recognition rule, does it matter? Nope. They've earned that money. So we have to add that $1,700 to their May revenue, even though the cash hasn't shown up yet.
And the exact same thing goes for expenses. Kraus's employees worked the last 3 days of May, but their payday isn't until Friday, which falls in June. The matching principle tells us the cost of their labor for those 3 days is a May expense because their work helped generate May's revenue. We have to record that salary expense now, not later when they actually get paid.
So, we've gone through and applied all our fixes, our deferrals and our accruals. We've fixed that misleading snapshot. So what does the true financial story for May actually look like? Let's see the big reveal.
The difference is, well, it's pretty significant. Look at the revenue. It wasn't $9,500, it was actually $11,600 once we accounted for all the work they really did, and the total expenses jumped by more than $1,000. That original net income of $2,300, it was just plain wrong. The adjusted, more accurate figure is $3,310. That is a huge difference in how profitable the company looks, and most importantly, it's the correct number.
And that, right there, is the whole point. We've just transformed a simple but misleading list of transactions into a true and fair story of the company's financial performance over the entire month.
So, if you remember just a few things from all of this, make it these. First, that initial financial report, it's never the real story until it's been adjusted. Second, this whole game is about timing. It's all about matching revenues and expenses to the right period. And finally, the easiest way to keep it all straight in your head, deferrals are cash first and accruals are activity first.
So, I'll leave you with a final thought. We just saw how much the numbers can change for one small consulting firm in a single month. Now, just imagine this exact same process playing out, but at the scale of a massive public company. The next time you see a headline about quarterly earnings, you'll know there's a much deeper story of all these adjustments happening just beneath the surface.